Well, what do you do about rising interest rates? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. I do have a line open if you'd like to call in with a question and or a comment. The number to call is 1-877-913-5357. 1-877-913-5357. You can also go to the website at www.prudentmoney.com. Send a question to the Ask Bob section, and I will get you taken care of. That's off the website, www.prudentmoney.com. 1-877-913-5357. Well, it's an awfully big week this week with economic reports that are coming out and Fed decisions on interest rates. I mean, it's all coming down to this week. I read an article this morning on CNBC that I thought was really direct and true, and that is this week I think really sets the course for the rest of the year. And believe it or not, I was talking to my assistant Alyssa about this morning. She goes, it's almost August. And it's just unbelievable how fast this year has gone by. It's also a time of opportunity because the market typically does really well in the last 5 to 6 months of the year. Now, of course, that is minus a bear market and that we're in one. So we'll have to see are we looking at recovery towards the end of the year or a deeper bear market. But I do believe it's on Wednesday, the Federal Reserve Board announces its decision on interest rates, whether they will raise them. And the thing about it is they raise the federal funds rate, which is the benchmark that every interest rate every interest rate is from the standpoint of credit cards to auto loans to mortgages, all look at the federal funds rate. If the federal funds rate goes up, chances are these interest rates are going up as well. That's going to be announced on Wednesday. That could be an aggressive move, as much as a point. I think that the stock market is pretty comfortable with 0.5% to 0.75% as in their fight towards inflation. But a 1% increase could be a little too much for the markets to handle, but we'll have to see how that comes out. Then also just as equally a big report is the growth number for the economy. Now remember, the first quarter of the year was negative growth, which means that we're halfway there to a recession. The second quarter is announced, I believe it's Thursday, could be Friday. I didn't look that up before I got on the air, but it's either Thursday or Friday. It's 7:30 in the morning, and it will determine if indeed we are in a recession or one's on the horizon. There's a lot of opinions as to if we are in one, if we're not in one, if we're going to be one, if we're gonna. It just all depends on who you listen to. Personally, if we are not in one, I think it's almost a given that we will be in one by the end of the year. I would be surprised if we were not in one, just because of the way things are working today and the effect that inflation has had. But we've got those two very big numbers coming out this week. And like I said, I agree with CNBC on this, is that it's probably going to set the tone definitely for the rest of the summer, which is not too much, about a month and a half, and probably for the balance of the year. But interest rates going up, we know they're going to go up, and we probably know that they're going to go up throughout to the end of the year. And you can argue whether or not the Federal Reserve Board is behind the curve, going to take the economy down by doing. I mean, there's a lot of things you can argue. What you can argue is its effect on consumer interest rates. Because if they raise interest rates, credit card rates go up, home rates go up, and automobile rates go up. And there's some benefits to them in raising interest rates because the guaranteed fixed interest rates on things like CDs and on fixed annuities, not necessarily fixed index annuities or variable annuities, but fixed annuities, which work a lot like a CD, all go up. So you're starting to see guaranteed rates, which is good for the person who's just saving money to save for emergency funds or whatever. And it's good for the person in retirement who is wanting to be conservatively based and wants a good fixed rate. Of course, fixed annuities are definitely outperforming CDs. And I don't know if CDs will ever catch up to them because insurance companies have really had the upper hand with rates ever really the past, I guess, probably 8 to 10 years. But like I said, auto loans will go up, home mortgage rates will go up, credit cards will go up. But what ends up happening if we see interest rates start to go up because Federal Reserve Board raised interest rates, and then we see that we're deep into a recession, which would normally pull interest rates down. So it's going to be an interesting week. One of the things I wanted to focus on, I mention this really quick as well. If you are sitting there with an auto loan, for instance, paying 5-6%, you still have the opportunity to refinance your car because interest rates are still, at least this resource I go to, are still in the 4% range, depending on how long you take it out and that kind of thing. But you're still in the 4% range. So if you are in the 5 to 6% range on an auto loan, then you have the opportunity, I'll do it rather quickly, to bring that interest rate down. Most people don't think about refinancing an auto loan. Home rates are in the 4 percentile range. Of course, you got to be careful with mortgage rates because of the fact that a lot of companies are charging points, money to buy down that interest rate. So you have to know whether there's points or not, or no points. And then there's credit cards, which we're going to focus on because the interesting behavior of consumers with credit cards right now, what's happening with credit card balances, and what the future looks like with credit cards. And consumers are almost acting as if it's no big deal to put it on the credit card. At one point, credit card balances were over $1 trillion. That was at the highest. Since the great credit card shrink happened, which is what I call what happened the last couple of years, ever since the pandemic came in, and balances started to go down. I think they got down to about 841 million, something like that. But definitely a good drop from a little bit over $1 trillion. My theory on that is that it's the effect of the pandemic and the effect of the free money that was given out by the government, and the fact that you got to remember there's always hundreds of millions of dollars of money going into credit card accounts each month from minimum payments or bigger payments or paying them off. But there's always money being paid to pay those credit card balances down. I think that we went through such a long-term period where people just were not spending money. They weren't adding balances to their credit cards. Therefore, credit card balances were going down because of the positive effect of payments. I think that was really, I don't think that there's any better of a reason for it. But now they're going back in the wrong direction. And it's really a time to assess where we are from the standpoint of unemployment, the stock market, of the economy, and decide from a consumer standpoint what you should be doing. Should you be just paying the minimum payments, or should you really be taking action to get into a plan to get out of credit card debt? And I'm not talking about a debt consolidation plan. I'm talking about getting into a real plan to get paid down and get these things taken care of once and for all. Because if we do get into a deep recession, don't know that for a fact that we will, but if we do, it's going to be tough. If we get into a situation where we have stagflation, I've heard that word before. Stagflation is when we have really high interest rates and a recession happening at the same time. Not a good situation. 1-877-913-5357. This is Bob Brooks. Stick around. I'll be right back. Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. 1-877-913-5357. During the break, I looked up where credit card debt is. I went to the debtclock.com, I believe. USdebtclock.com, something like that. If you Google it, you'll get there quicker than trying to figure out what I think it is. Anyway, it shows all the numbers in real time, and it has credit card debt at $1.1 trillion already. But at any rate, the bottom line is the balances are going in the wrong direction. According to LendingTree, nearly 1 in 5 Americans are afraid to check their credit card statements. According to creditcards.com, the average interest rate is 17.46% as of July 20th. Get this, it's projected to be at 19% by the end of the year. That's 19, that's almost 20% as the average interest rate. Please think about that for a second. Because That is a lot of interest to pay down on things we could probably wait for. Now, here's the thing. I get the fact that some of the spending, I think a lot of the spending that's put on credit cards is covering, it's necessity spending. It's helping out to replace money that's normally there that's not there. So I think that consumers, if we could really see what's going on, I think that consumers are spending money on everyday expenses on their credit card. And that's one thing. Desperate times do require desperate measures. And no, I'm not advocating to do that. If it means you keeping your mortgage paid, yeah, well, I think I would put it down in the credit card. I mean, not the mortgage payment, but the other payments. But according to Upgraded Points report, consumers have been going to credit cards to pay for vacations, computers, furniture, automotive expenses, and etc. So 19 to 20%. Now here's what is really interesting is that President Obama signed into law the CARD Act. And the CARD Act, the Credit Card Act, but I think it's just called the CARD Act, was designed to eliminate these higher rates and to get rid of consumer abuse. Because although it's still bad, it was really bad in the early 2000s to the mid 2000s. But here's what they did, and this is very important for the context of what we're talking about today, is that when President Obama signed that act into law, which was May of 2009, he gave the credit card industry 16 months before they had to follow it. Of course, what do you in every piece of legislation that punishes the people who pay for elections always has a back door. This one definitely had a back door. Gave them 16 months to do things like change all of their contracts from fixed rates to variable rates. And remember, even today, they can still change any aspect of the contracts that they want. Definitely could before the CARD Act. The CARD Act was supposed to stop that. And maybe it did to a certain degree, but we'll talk about that in a minute. But it gave them a chance to change to variable rates. So what variable rates are, a fixed rate is a rate that stays fixed. It doesn't move, it doesn't change. A variable rate goes up and down with the federal funds rate and interest rates in the economy. So this is why we're probably going to be at 19%, but I would think we'll be well over 20% when it's all said and done. They gave them the ability to go close accounts. How many of you had your credit card closed? We couldn't use it anymore. And it wasn't your choice to close it. They closed it. The credit card company closed it. They had the ability, and they took way advantage of this, to reduce balances, to rewrite fine print. And so today, I mean, they could take interest rates up just about as high as they want. But still, they had what was called penalty rates back before the CARD Act was passed, and those penalty rates were 27, 28%. We're not that far off from 28 or 27%. Especially, I'll read to you an offer here in a little bit that it is at those levels. So you got to remember that we're in an active rising interest rate situation, and credit cards will be affected by that. And the downside is that when any time that you or I open a credit card, we sign a document that says it's okay if you raise my rates. So that's the first thing that you need to know. The second thing you need to know is that credit card companies have a tendency to take advantage of what I'll call interest rate crisis. When things are going up, things are falling apart, and if we start getting into a recessionary situation, that could happen. And so they assume you're not paying attention, and they change things. And I had heard of this happening before, and then it happened to my wife's Circuit City. And I can talk about Circuit City because they're not around anymore. I used to love that store. And they knew how to market. You'd walk into that store, and immediately your eyes are drawn to the huge TVs on the, back then it was the plasma TVs, nothing like they got today. Anyway, I digress. They used to love to go, it's like going to the toy store, the adult toy store. TVs, electronics, everything. Well, so my wife bought something on no interest for 12 months. And so I paid that note every month for 11 months. And the whole idea was to take advantage of no interest rates and pay it off by the 12th month. It was like the 23rd day of the month, every single month, like clockwork, I'd pay it. Except the last month of the introductory offer, they adjusted the payment day to the 22nd. Out of the blue. Of course, I paid on the 23rd. I was late, and they added all of that interest into my account. So I went up to Circuit City and I said, this is what happened. Why did y'all change the date? And this guy who was the general manager acted like, oh, this happens all the time. They pull this trick all the time. I finally got it resolved. But it's just, you just got to keep your eyes out on credit cards and the games that they play. The third thing is to watch out for good deals. The truth is, credit card companies are in the business to amass debt that you owe to them, because think about it. If you get the opportunity as a company to make 19 or 20% off your money year in and year out, what a great deal that is. So they want you to roll over that high interest debt. They want to give you a couple of years of free, of no interest, and that kind of thing. Because at the end of that time period, it's going to revert back to the 14-15% interest rates, if you're lucky. I got a deal here sitting in front of me from Wells Fargo that after the introductory time period, your interest rate will be between 14.49% and 26.49%. So if you had stellar credit, your interest rate would be 14%. If you had bad credit, but you could still qualify, 26% interest rate. That's not a penalty rate. It is just the deal. And of course, that can go up because of the fact that interest rates are going up, because it's remember, a variable rate. Then I saw this the other day. This was on Discover credit card. The offer was, hey, transfer your balance over to your card and get 0% for 9 months. I have yet to see this at 9 months. And then they were going to charge you a 6% transfer fee. What they're not telling you is a transfer fee is just like an interest rate cost. It's a cost for debt. So that first year, you would have paid roughly 8% in interest rate costs during that first year when you start considering the percentage to transfer it over, and then the 14% it was going to afterward. We will wrap up this last part of credit cards tomorrow and talk a little bit more about this. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.